All right, so most investors with a medium to low risk appetite often gravitate towards debt funds, but when opting for market linked instruments. However, the new tax rule in the new financial year have come into play, leading debt investors to revisit their investment portfolio for higher returns. So, should you choose debt mutual funds, fixed deposits, or rather insurance products like a unit linked investment plan, which is ULIP, to gain maximum returns in the debt space? Let's answer all of these questions. We have Sameep Singh, Product Head Investments Policy Bazaar, with us. Sameep, hi, good evening, and welcome to the show. So, we are going to talk about, in fact, we are going to compare the debt fund in a ULIP with debt mutual funds and a fixed deposit, which are much more preferred and comfortable investment instruments for most of the investors now. Let's just get an overview of what exactly is a ULIP plan, because these plans offer fund options which are equity and debt based as well. It's a product which has a mix of insurance as well as investment. Now, focusing just on the investment part and the fund part of it, what kind of options are ULIP 2.0 or the modern ULIPs offering?
See, ULIPs is a market-linked instrument. It also, just like a mutual fund, and it also has an additional benefit of a life cover associated with it. Now, the biggest benefit of investing in a ULIP, apart from the returns, is that you get up to 2.5 lakhs tax-free returns. So any investment, if you make an annual investment of up to 2.5 lakhs that normal retail investors would do, you would get tax-free returns. That is better than doing a debt mutual fund or an FD. Okay, so I take an example.
Yeah, Sameep. So I want to come to this aspect, but maybe later on in the conversation, in the discussion, because first I want to establish this to our viewer, whoever doesn't understand ULIP or maybe have put money into it wrongly. What kind of investment options you have in a ULIP?
See, ma'am, in a market link plan like a ULIP, basically you, for example, you invest 1 lakh rupees annually. Now you have a choice to make whether you want to invest it in an equity fund, a debt fund, or balanced funds, which are a mix of debt and equity. Now this is up to the customer. Whichever fund he is more, his risk appetite associates with more, he can choose that. Now the returns, see, the underlying asset of both a debt ULIP and a debt mutual fund are the same, and the same applies for an equity ULIP and an equity mutual fund also. For them, the underlying asset is stocks, and for a debt ULIP and a debt mutual fund, the underlying assets are government bonds, government securities, and corporate bonds. So the return will not be very different, apart from the fact that earlier what used to happen was a common misconception that ULIPs are extremely high cost. But with ULIPs 2.0, costs have gone down comparable with normal mutual funds. ULIP costs are as low as 1.25% a year. So costs are down, and the underlying asset in both a ULIP and a mutual fund are the same in the end. So the returns can be comparable.
Sameep, when we talk about equity and debt option, typically what kind of investment instruments are these funds talking about? Where do they put their money? You're talking about stocks or other avenues of equity, and when we're talking about debt, what kind of options are available? Could you elaborate on that?
Sorry?
Could you elaborate the kind of investment instruments, equity and debt part in a mutual fund, in a ULIP plan actually invests in?
So, ma'am, the equity ULIPs invest obviously in stocks. They can be any large cap, mid cap stock like Infosys, TCS, right? So retail investors cannot pick and choose stocks on their own because they'll not be able to identify which stocks to invest in. So a fund manager does it on their behalf. It is similar to a mutual fund. And in terms of, if you talk about a debt fund, there they invest in AAA rated corporate debt or government debt, which is state and central government securities. Basically, the state and central government also borrows, and they issue securities, and the mutual funds invest in them. They are almost guaranteed, or it's not almost, they're 100% guaranteed the government debt, because obviously the government will not default. The returns keep varying basis on what tenure you have purchased for. So all in all, what I would say is that debt funds invest in government securities and corporate securities, and ULIP and equity mutual funds invest in stocks like TCS, Infosys, different companies basically. Since retail investors cannot do that on their own, these companies, these fund managers do it on their behalf.
Talk about the debt aspect or debt funds in a ULIP scheme, Sameep. Explain us how many times in a year can you actually change this? Can we go from equity to debt, or if at all we've started our investment maybe in equity, we need to continue having the same kind of fund and same kind of exposure to the asset class?
Yeah, see, the biggest benefit is that there is no exit charge when you move from equity to debt or debt to equity in a ULIP fund. So basically, when you invest in a ULIP, there are 8 to 10 funds in that, and these are of different categories. There are equities, there are debt funds, and there are balanced funds. You can switch between the three basis your risk appetite or basis you see the performance of these funds, and you can keep switching. And there is no exit or entry charge in these funds. Whereas if you do that in a mutual fund, multiple times in a year, you might end up paying charges, which are as high as 1% of your returns that you garner.
A debt mutual fund and a ULIP debt fund, what are the similarities? Let's ignore the tax part as of now, but then let's talk about the investment instruments and the avenues. What's the similarity?
The underlying asset class that they invest in is mostly similar. Debt mutual funds might take slightly more risk, and so ULIP funds only invest in AAA rated corporate security and state government and central government debt. Mutual funds might take a bit more risk and might, to give higher returns, might invest in slightly AA rated securities as well. That's the only difference. The underlying assets mostly remain the same.
So now
that is why returns also for these would be similar. That's what I've been trying to highlight.
So now, a ULIP is a product where you have to be invested for long. First of all, it's always recommended that you need to have your insurance and your investment separately. A ULIP is not supposed to be the first preferred mode of investment, because an investment plan through an insurance, which is not a pure insurance plan for you. You might as well have a term insurance and proper life cover with you. But when we are investing in something like a ULIP, and that to a debt plan in a ULIP, is it advisable to stay locked in for a longer period of time? We don't know where the interest rates would be going. Not talking about the current scenario, which obviously signals towards a rate cut maybe later this year or maybe in few quarters now. Typically or generally also, in a debt ULIP plan or a debt ULIP fund, for how many years should one be locked in? I mean, there is a 5 years lock-in, obviously, but then just for tax benefit doesn't make buying it, right? You need to have a medium to long term. You need to have a medium to long term horizon if you are locking in yourself in a product like a ULIP.
See, ma'am, only being stuck in a debt fund, I would not put it like that. See, you can keep switching basis the kind of returns that you see on a year-to-year basis also. I'm not saying lock in your money for 20 years in a debt fund. See, if people want to invest in debt funds, they don't want extra risk associated with equity funds, they can stay invested. But on a year-to-year basis, you can keep changing whichever way the interest rate cycle goes, right? You can keep switching, and there is no exit or entry charge in any of these funds. So you can keep switching between equity, debt, and vice versa, and this is as per your risk appetite.
Means that if at all you want to take advantage of the benefit of the EE status that I think the ULIP has, you need to make sure that your premium doesn't cross 2.5 lakhs.
Yeah, so see, the ULIP has an extra benefit that the insurance companies have, that extra tax arbitrage, I will put it like that, where if you invest up to 2.4, so up to 2.5 lakhs a year. So I take an example. If I invest up to 2.4 lakhs a year for 20 years, so I pay for 20 years and I stay invested for 20 years at a 8% return. See, mutual funds and ULIPs in a debt scheme over 10 years, in the last 10 years, that the average return has been 7 to 8%. So we assume that you get an 8% return. 1% we deduct expenses. So you will make around 1.05 crores. So on the 1.05 crores that you would make, the principal invested comes out to be 48 lakhs. So I gain around 57 lakhs over 20 years. Now, if you invest in a debt mutual fund, on those 57 lakhs, you will end up paying around 17.8 lakh rupees as taxes at a 30% tax bracket. And in a debt ULIP, you will end up paying no taxes. So there the tax arbitrage is immense, right? And the similar scenario applies to a debt equity mutual fund and an equity ULIP also. There's a tax arbitrage of 10%. In a debt ULIP, you will be taxed at your tax slab. In an equity mutual fund, you will be taxed at 10%. So both ways, there's an immense tax arbitrage that everybody should take benefit of and invest at least up to 2.5 lakhs in a ULIP product. They are equally competitive, low on cost, I don't see any reason why you should not do it.
What are your recommendations for ULIP debt fund?
See, my recommendations are that in the last 10 years, how I've seen performances go, the top companies that come to my mind are Tata AIA Life, Birla Sun Life, ICICI Prudential. These have got good debt funds. Returns have been in the range of 7 to 8%. Okay. And see, then again, if you're not comfortable with the return that you are getting and you aspire to get a higher return, you can always switch to an equity or a balanced fund, right? So that flexibility is always there. So we are not saying that you should only stick with a debt fund, but there's a tax arbitrage that you should take complete benefit of.
Thank you so much, Sameep, for being on the show and helping our viewers with all the aspects of debt ULIP fund. On that note, let's take a quick break, and post that let's discuss PPF and also how can you buy a term insurance policy if you have a critical illness after this break.